Gold has entered 2026 with the kind of volatility that demands attention. The opening weeks of the year have already produced structural moves that define the entire trading range for the months ahead. The question this analysis addresses is whether that volatility is building toward a new directional trend or whether gold is still deciding. This video examines the dominant range that January and February carved out and why it is the reference point controlling this market right now. We look at the weekly swing structure developing within that range, what this week's price action is doing to it, and the specific levels that define where gold goes next. By the end of this analysis, you will know exactly where gold stands within its dominant range, what the weekly structure is telling you about directional intent, and the precise conditions that confirm whether buyers are reclaiming control or whether this week's volatility is something more significant. This is the structured read you need before Friday's close. Welcome back. We are Bitcoin Capital Gold, built for serious traders and investors who want structured technical analysis and capital discipline across Bitcoin and gold. Every day we answer 5 structural questions. Are the time frames aligned? Where are the key price zones? What is volatility signaling? What are the macro markets telling us? And what must change to shift the structure? Today, all 5 converge to paint the same picture. We begin with the time frames because time frame alignment tells us whether the wind is behind the buyers or against them. On the monthly chart, both January and February 2026 closed bullish. February closed above its open by $432. Buyers controlled the entire month from open to close. The weekly time frame has also been constructing a sequence of higher highs and higher lows since the February low. Both time frames are aligned and pointing in the same direction. That alignment tells us the bullish momentum is not a one-session event. It has been building across multiple time frames simultaneously. That is the foundation everything else in today's analysis rests on. So in a moment, you will find out why we call it a dominant range. But first, let's define what we mean by a dominant range. A dominant range is a candlestick or candlesticks that overshadows subsequent bars, to the extent that all price movement is contained within them. If it helps, think of every subsequent bar as an inside bar, waiting to break free from the high and low that are overshadowing it. Once you see it on the chart, you cannot unsee it. The relentless buying frenzy of 29th January seemed unstoppable. Buyers drove gold to a new all-time high of $5,627, a record that felt in the moment like the beginning of something larger. But when sellers stepped in, they did so with a vengeance. Sell orders cascaded price down from that high, closing the session significantly below the peak. Buyers had overstepped their mark, and sellers were delivering the reality check. The following session extended that punishment, and by 2nd February, gold had been driven all the way down to $4,423, from all-time high to structural low in 5 sessions. 2 days of extraordinary price action carved out a range of $1,204, and every session since has traded within it. That is what we mean by a dominant range. The high of $5,627 and the low of $4,423 are the bars overshadowing everything that follows. The midpoint of that dominant range sits at approximately $5,025, and this level acts as the balance point between the two extremes. Think of it as a line in the sand. Above it, buyers are re-establishing control and demonstrating that the February low was a floor worth defending. Below it, sellers are suppressing upside and keeping the pressure on. So we now have 2 clear anchors framing every session, the psychological $5,000 level near the low end of the range and the all-time high at $5,627 above. We watch how price negotiates between them. From the 2nd February low, buyers began the work of rebuilding. The evidence of that recovery is visible in the weekly structure. Each week since has refused to revisit the February floor. The market has been printing higher lows, and by the week of 23rd February, it had pushed to a new recovery high of $5,299, the clearest signal yet that buyers were attempting to reclaim the dominant range. 4 consecutive weeks of higher highs and higher lows. That is not noise. That is a developing weekly upswing working directly toward the dominant range ceiling. The minor lows that mark each step of that recovery are not just reference numbers, they are the footprints of buyers defending the structure at each pullback. The first defense came in early February. The second came in mid-February at $4,854. Each successive low was higher than the last, buyers stepping in earlier at higher prices, which is exactly what a healthy upswing looks like. If price were to close below $4,854 on a weekly basis, those footprints start going in the wrong direction. That is the level that matters for the integrity of the weekly swing. Now here's the mistake most traders made watching Tuesday's session. Tuesday, 3rd March was not a normal session. It was the most explosive single-day gold has seen in weeks and tested the resolve of every buyer who had been defending this structure. Price reached an intraday high before collapsing all the way to $5,005, breaching the psychological $5,000 level that sits at the low end of our dominant range equilibrium. Most traders watching that breach read breakdown. That was the mistake. What they missed was the close. Buyers absorbed that entire move below $5,000 and closed price back above the equilibrium at $5,124. A close above equilibrium after a test below it is not a breakdown signal, it's a defense signal. Wednesday confirmed the read. Price stabilized, opening and closing in a narrow range. The structure held. A wick is an attempt, a close is a statement. Tuesday was an attempt. Wednesday was the statement. Volatility gives us an under-the-hood look at the market's temperature, and we measure it 2 ways. We look at the size of daily ranges to gauge energy, and we compare how each session closes relative to its open to gauge who's winning. Before this week, the picture was one of deliberate compression. 5 consecutive sessions averaged around $118 per day. Ranges of $137, $160, $101, $77, and $116. Falling ranges tell you the market is holding its breath. Then Tuesday detonated, a range of $389, more than 3 times the recent average in one single bar. A market that holds its breath for 5 sessions and then releases in one explosive bar tells you something significant has been building beneath the surface. The close to open data adds another layer. Those 5 sessions of compression all closed bullish, buyers consistently controlling where price finished each day. Monday this week closed bearish. Tuesday closed bearish, a bearish deficit from open to close of $212. But Wednesday closed bullish again. 2 bearish closes followed immediately by a bullish recovery. Here's what that tells us. Neither side has durable control right now. Sellers are present but not sustaining. Buyers are defending but not yet dominant. The market is in a genuine tug of war, and Friday's weekly close is the referee. From a macro perspective, the US dollar index has been constructing higher highs and higher lows and broke above the $98 resistance we identified as the key ceiling. A stronger dollar is historically a headwind for gold. Capital flowing into the dollar tends to rotate away from hard assets. However, the dollar has not extended meaningfully beyond that level. A breakout that stalls is a warning, not a confirmation. If dollar momentum is fading, that headwind weakens, and that matters directly for gold's ability to push toward the dominant range ceiling. Looking at broader risk appetite, the Nasdaq remains trapped in a narrow range, unable to break higher, unwilling to break lower. When equities aren't moving, institutional capital is not rotating. That holding pattern is consistent with what we're seeing in gold, a market that has the structural argument for upside, but is waiting for the macro environment to give it permission to move. Here's what the complete picture is telling us. Gold entered 2026 with a defining volatility event, a buying frenzy to an all-time high, followed by an immediate and forceful rejection that set the dominant range. Since then, buyers have been methodically rebuilding from the February low, constructing a weekly upswing within that range. This week's explosive Tuesday tested the psychological floor of that structure and held. The weekly swing remains intact. The monthly and weekly timeframes remain aligned bullish. What must change for the structural picture to shift? On the upside, a sustained close above the dominant range ceiling of $5,627 is not just a technical breakout. We're only in the third month of the year, and a new all-time high from here would not only confirm buyers have broken free of the dominant range, it would signal that gold is capable of significantly higher prices across the remainder of 2026. The implications of that extend well beyond a single session. On the downside, a weekly close below the mid-February low of $4,854 breaks the sequence of higher lows and challenges the integrity of the entire recovery. Friday's weekly close is the first verdict on which way this resolves. We monitor, we do not anticipate. Discipline over prediction. Before we close, a word on why this channel exists and why Bitcoin and gold are discussed alongside each other here. Gold is taking bigger steps upward. The scale of its moves in 2026 is beginning to redefine it, not just as the traditional safe haven, but as an asset capable of the kind of directional momentum that commands serious capital allocation. That matters for how we think about portfolio construction. It is our view that the traditional narrative, Bitcoin as pure risk asset, gold as pure safe haven, is being challenged by the market itself. We established Bitcoin Capital Gold precisely to examine that conversation. There is no reason why these two assets cannot coexist in a balanced, disciplined portfolio, each serving a different structural role, each informing the other. We will develop that thinking further in future videos, but the relationship between Bitcoin and gold is not a footnote to this channel. It is the reason for it. So, to answer our 5 structural questions, are the time frames aligned? Yes. Monthly and weekly are both in an uptrend, aligned and pointing in the same direction. Where are the key price zones? Defined. The dominant range ceiling at $5,627, the equilibrium at $5,025, and the structural floor at $4,854. What is volatility signaling? A compression that broke with one explosive session, followed by immediate stabilization. Neither side has durable control yet. What are the macro markets telling us? The dollar is pressing higher but stalling. Equities are range-bound, and neither is providing a decisive catalyst in either direction. What must change to shift the structure? A close above $5,627 opens the door to significantly higher prices. A weekly close below $4,854 challenges the recovery. Friday's close answers the immediate question. We produce daily technical analysis on Bitcoin and gold every day at 7 a.m. EST. If you found this video useful, consider liking and subscribing so you don't miss tomorrow's video. What do you think of the levels we gave? Do you agree? Do you have your own levels you're watching? We'd love you to share your thoughts. Comment below so we can all discuss. Gold rarely moves without reason. This week gave us the reason. Friday will tell us what it means. Until then, manage your risk and look after your capital.